I'll go ahead and get started. Appreciate everybody for being on the webinar here, and hopefully technology is not my strong suit, so I appreciate those of you that help us get this all started. And for those of you joining us, appreciate the opportunity to share this product with you. This is I think it's a relatively new product through Brighthouse called their SmartCare product, and it is the kind of the latest version of the asset-based long-term care products out in the marketplace. So if you've looked at this marketplace much, you'll know there's probably 3 or 4 key carriers products in this marketplace. Brighthouse joins us now on a limited distribution process here. So we're lucky and thankful to have them to be able to offer to our agents. And it's a unique product, very competitive when we're pricing it out. I've had a chance to run several quotes and comparing it against the big names out there that have, maybe not big names, but the ones that have been out there for a while, it competes very favorably. So we're excited to be able to offer this up. And with that, I'll hand it over to Matt. Appreciate it, Matt.
Perfect. Thanks so much, Al, and thanks everybody for joining us today. Yeah, it's exciting. The product is relatively new, and as Al had mentioned, very limited distribution. So it's not out there to many producers and general agencies out there. So it's an exciting offering. What we have. What I want to do today is really just go over the product, its functionality, go over an illustration how it looks, as well as look at how it stacks up in the marketplace from a benefits perspective, as well as a pricing perspective. So, Brighthouse, is about 5 years old now as a company. For those of you who are not familiar with Brighthouse, it was established by MetLife. So MetLife decided they no longer wanted to be in the individual life insurance and annuity space. They wanted to focus on their international insurance coverage and business insurance. So they did an initial public offering forming Brighthouse Financial. Brighthouse Financial is one of the largest providers of annuities and life insurance in the United States. So extremely strong company, strong financials. Now, when we launched the product, we didn't just want to look at the marketplace, copy another product, and price it out a couple dollars better. We wanted to make it so it was really consumer and producer friendly. And so we conducted a tremendous amount of research with thousands of producers and consumers across the country to really figure out some pain points that they were experiencing with the hybrid long-term care marketplace, as well as traditional long-term care and life insurance. And so through this research, one of the biggest things that came out to us was the severe need for a long-term care plan. And one of the things that jumps out to me when we look at this slide here is the home health aid services rising north is 6%. And when we look at that, these numbers are prior to COVID. So you're seeing that even rise even more rapidly as people are well aware of what happened with the COVID environment in the long-term care facilities. So extreme need, and we really targeted this with our hybrid life insurance long-term care solution. So as many of you are aware, a hybrid life insurance long-term care solution is going to be a combination of the traditional and life insurance, making that hybrid. So again, what we did was we tried to find some pain points, right? Some of the pain points experienced with life insurance long-term care marketplace, and we really tried to make it easier with SmartCare in 3 facets. So if you take anything away from this this webinar here today, just be sure that SmartCare is easy from an application and new business submission process, easy to grow the long-term care benefits, as well as the cash surrender value in the policy, as well as easy at time of claim, as it's a cash indemnity policy. So when we look at this application and new business, how did we make that easier? So with SmartCare, it's only a digital application. We don't ever have any face-to-face requirements. And so for clients 65 and under, again, it's just that digital application. We'll do database checks on our end. And if the client's relatively healthy, 65 and under, we have that underwriting approval the next business day. So I've had a tremendous amount of cases, applications received, policies approved the next day. We have these cases issued well within a week. So extremely lightning fast for our industry from a new business perspective. And then, when we look at the hybrid long-term care marketplace, those of you that are familiar, you typically see, return of premium options, right? So guaranteed return of premium, you're going to look at 70, 80% return of premium. Maybe some options are even at 100% return of premium. But if you have a young enough client, say you had a 50-year-old individual, and if you have a 70% return of premium option on the policy, a lot of those consumers out there weren't too crazy about having a stagnant asset on the balance sheet. And so what we did was we're the only linked benefit hybrid long-term care offering on an index universal life chassis. So that allows us the ability to grow the cash surrender value in addition to the long-term care benefits over time. So we have the ability for our cash surrender value to exceed premiums paid, which is unique in the marketplace. And then again, the third thing we tried to make easier was that time of claim. So it's a cash indemnity solution. So obviously no receipts are needed. It's a lot easier for your clients as well as their those that are helping them through the claims process. And then you get the full economic benefits. So you have access to the full monthly benefit no matter what the incurred long-term care expenses are. So extremely valuable when we look at how we made it easier here in those three ways. Now, again, structuring of the policy. You're looking at a premium. That premium is going to support a death benefit and cash value component of the policy. Now, over the first 24 months of claim, that death benefit will be exhausted. And then you'll have the ability to add either a 24 or a 48-month extension rider. And so the total benefit duration with SmartCare, you have the option of either 4 or 6 years. Some of the carriers out there in the marketplace, they have a tremendous amount of different options. And SmartCare, we arrived at the 4 and 6 year benefit duration. The first thing, 4 year, right? The average length of LTC claim based upon all the studies out there is typically less than 4 years for both males and females. So having a 4 year benefit duration allows you to provide the greatest monthly long-term care benefit and potentially putting the most money in your client's pockets at an average length of long-term care claim. And then that 6 year benefit duration, we added that onto the policy. That's what the market dictated. Also, we wanted something for some prolonged claims like dementia and Alzheimer's. So that's the structuring there. Now, when we look at inflation protection and the options available, we designed it again to be pretty simplistic with SmartCare. So when we're looking at our long-term care coverage options, we have 3 options. The first is going to be your level long-term care benefit, and that's going to be essentially no inflation protection. Most instances when you're looking at a long-term care plan without inflation protection, those are those front-loaded cases, right? Clients in their mid-60s into their 70s where they're not overtly concerned with inflation protection, as claim could potentially be coming sooner than later. And so they want to buy as much benefit as of day one, as claim could potentially come sooner than later. The next option, again, this is unique to SmartCare. So we're the only policy out there in the marketplace that allows benefits to grow based upon index count performance. So based upon major market indices, the clients have the ability to grow their long-term care benefits. So again, extremely unique. Nobody in the marketplace has the ability to grow long-term care benefits based upon major market indices besides SmartCare. And then the third option here would be a more traditional 5% compound inflation. And typically you'd look at that for extremely young clients where you have the ability to grow at a faster clip. Now, similar to other index universal life policies in the marketplace, this is the structuring, right? So an index universal life policy is going to provide upside growth potential up to the policy's cap with downside protection with the policy's floor. So with SmartCare, we have a 0% floor for that downside protection, current cap of the S&P 500, 9%. And so it's an annual point to point. It's going to look at the performance of the index count they're allocated to over an annual basis, and the return that's going to be credited to the policy, taking in consideration their cap and floor structure. We don't have anything crazy going on as far as non-guaranteed bonuses or any bonuses in addition to what we're showing here. So it's a very simplistic structure to understand when looking at our annual point-to-point cap structure with SmartCare. Now, to dive into that simplistic underwriting approach a little bit further. So again, it's extremely simplistic, quick and easy with our application process. Again, no paper, it's all digital application process. It can be electronic signed by both the consumer as well as the producer, illustration signed in the electronic application. And so it really was designed to be extremely consumer friendly, especially, in this COVID environment, right? A lot of people are hesitant to go meet with an insurance agent face to face, or for anybody that for that matter. It really opened a door to make this easier for those meetings that you're having, Zoom meetings and telephone meetings, where you don't have to have anything face to face. Again, there's never going to be any blood or urine requirements, no face to face requirements to SmartCare. And then pretty unique is a cognitive interview requirement. We go all the way up through age 65 where there is no cognitive interview. Most carriers, 60 plus, you're going to look at a cognitive interview requirement. So again, this is extremely attractive. I can't tell you how many times when I was working at other carriers or, as a general agent, somebody that was well with it comes in and has a cognitive interview scheduled, and all of a sudden they're not paying attention on that cognitive interview and they botch it and fail it, and it just becomes nightmare. So not having a cognitive phone interview requirement all the way through age 65 is extremely attractive there. And then again, the ability to have that underwriting approval within 24 hours. So when we look at SmartCare, we designed this to really a specific segment, right? So it's not going to be the solution for everybody, just based upon funding requirements solely. Our maximum premium duration is a 5-year premium with annual premiums and a total cumulative premium minimum requirement of 50,000. So we designed it really for this secure achiever segment. And essentially what it is, the average age of a secure achiever is approximately 55 years old. If looking at this, about half of them already own an annuity, and 3/4 of them already own existing life insurance. And they do have the income and assets available to fund these types of solutions. So investable assets, $250,000 plus an annual income, typically is north of $100,000. So before I dive into how it stacks up in the marketplace as far as a competitive perspective, I just want to take a pause and see if there's any questions out there.
I'm not seeing any questions. Sarah, do you see any questions?
Nope. Just so you know, if you do have a question, hit the raise hand button or the chat button. And as you know, Al will be watching, and of course I will be proctoring as well, just to make sure all your questions get answered. Don't see anything as of yet. So yeah, thank you. Let's keep going.
All right, perfect. So I just wanted, again, before diving into the marketplace and how it's.
Sorry, we just got 2 questions.
Okay, cool.
Dennis Drake, can it accept qualified money? James Anderson, what are the over 65 underwriting requirements?
Yeah, great question. So as far as the qualified dollars, no, it can't take qualified money directly. If you're looking at qualified assets to fund long-term care solutions, you could do it 2 ways, right? You could take withdrawals from that qualified asset over a 5-year period, and then spread that tax liability out over 5 years, and then use those after-tax dollars to fund the policy. You could also do a rollover to an SPIA, do a 5-year period certain, again use those after-tax dollars to fund the solution, but not directly. You can take qualified dollars. And then great question as far as the underwriting approach, clients 66 through our maximum issue age is 75. Still the same requirements where there's the digital application database checks that we conduct on our end, but there will be a cognitive phone interview at that point in time with one of Brighthouse's underwriters. So again, no face-to-face requirements there. And then we'll automatically order their medical records on our end for those older ages.
Thanks. One more question too.
Yep.
Let's see, Kevin Hovila has a question. What does the cognitive interview consist of?
Yeah, so it's pretty typical that of all carriers, cognitive interview questions are a lot of memory recall. So when you're looking at that, a clock draw, things like that, as far as your typical cognitive interview requirements.
Right. Looks like that's everyone. Thank you.
All right, perfect. Appreciate the questions. So again, I wanted to dive through the illustration, just a few pages really to give you an idea of how this looks, and then we'll continue on as far as how it looks at as far as benefits and price and perspective in the marketplace. So one very cool report that I like to add onto our illustrations, and a lot of times you'll be having a long-term care conversation with a client, especially with these hybrid long-term care solutions where they have the assets to fund it, and they're considering self-funding the long-term care event versus utilizing the insurance coverage, right? And so this report's utilizing SmartCare versus self-funding is a great way to show them, yes, you certainly can self-fund a long-term care event, but why would you? The leverage is here, and it really does a great job of showing how. So if you look at this is essentially saying if the client were to take $100,000 and allocate it into an alternate investment, this is this teal line right here, and that alternate investment grew at a 6% annual compounding growth rate. 55-year-old guy by age 80, you're looking at that to grow to about $429,000 by his age 80. So again, it's something that could potentially help for a long-term care perspective, but it's not going to provide the leverage that these asset-based long-term care solutions do. So if we look at this green line right here, this is the day one guaranteed long-term care leverage that SmartCare provides. So as you can see, $472,000 as of day one. In comparison, by age 80, that alternate investment still has not achieved that day one benefit. And then this line right here, if we're looking, this just assumes that based upon historical average returns, the projected growth by age 80 for SmartCare is about 840,000. So again, substantial leverage, 429 versus 839 really does a great job showing your clients, yes, you can self-fund a long-term care event, but ultimately it doesn't make any sense. Now, when we're looking at this SmartCare illustration, again, it's an index universal life policy. We designed this based upon historical average returns when we're looking at performance and 9% cap, 0% floor. So when we look at the historical average returns page, this is essentially saying we're looking at every possible 25-year period between December 31st of 81 to December 31st of 2021. With the market being open, that's over 10,000 data points they take into consideration, and the average rate of return would have been a 5.75%. And then again, you have your initial baseline guarantee with the policy. Day one guaranteed long-term care leverage with SmartCare, as well as death benefit coverage, is going to lead the link benefit marketplace. So kind of for premiums paid, you're going to have the highest death benefit as well as highest day one long-term care leverage. So this instance, you have a 55-year-old married guy. He drops in $100,000 single premium. He has a guaranteed pool of long-term care benefits over a 6-year benefit duration as of day one of $472,000 or $6,500 per month. Guaranteed minimum death benefit of $160,000. And as you can see, the guarantees carry for life. So even if there's never any performance in the S&P 500 over the next 30, 40 years, again, unrealistic, but you still do have your baseline guarantees intact with SmartCare. And as you can see, if the market does what it has historically done, so as you can see, top right-hand corner, we're showing a 5.68% return, just shy of the average 5.75 that we looked at for the return. You could see the policy projects to perform extremely well. So you still have your guaranteed death benefit of the 160,000, but now you see your long-term care benefits are growing over time. So if we look at projected benefits, in 20 years, you're looking at the pool growing to about 745,000 or 10,300 per month. And then you see the cash surrender values growing over time. So again, if we look at this 20 years out, you're looking at projected cash surrender value of about 112,000 versus the $100,000 premium they put into the policy. So again, we look at the marketplace, typically you see 70, 80% return of premium. There's even options that are less than that. The potential to grow the cash surrender value is a nice feature that's not available in a lot of the other carriers out there. Do see there's a question here. Yep. So James, great question. Is there a cap on the growth with the investment? Yep. So with any index universal life policy, in order for the insurance carrier to provide the floor and downside protection, they have to hedge their risk. So in order to hedge the risk, they have to implement a cap. So the cap rate currently is 9% with the floor of 0%. So for instance sakes, if there's a 10% growth in the S&P 500 over that given year, 9% would be credited, as that's the cap. If there's a 5% growth, that would fall within the cap and floor structure of the policy. 5% is what would be credited. And then if there's ever a negative return, like 2008, for example, sakes, negative 25% return with the markets, you're looking at the policy having that downside protection with their 0% floor. So now that we went over the illustration and kind of functionality of the policy, again, if there's any questions, don't hesitate to ask away. But I just want to give you an idea of, kind of how it stacks up in the marketplace, right? And so for this comparison, we looked at the other extension products, right? The pure long-term care leverage solutions. We didn't focus on the acceleration of the death benefit products that some of you may be familiar with, as the long-term care component on those policies isn't really what it was ultimately designed for. That's going to be a death benefit need first, with the chronic illness or long-term care rider filling a secondary need. Whereas these extension products, the primary driver is purely long-term care leverage, with death benefit filling that secondary need. So when we're looking at the issue ages, SmartCare issue ages 40 through maximum issue age is 75. We could take all premium durations all the way up through our maximum issue age. We never had any restrictions due to COVID-19. So it's a very competitive solution for most individuals that are looking for long-term care solutions. And again, this goes back to what I was talking about before. With SmartCare, we don't have a tremendous amount of different benefit durations, and we did that for a reason. So all these other carriers that have 3, 4, 5, 6, 7, 8, 9, 10 plus years of long-term care benefit durations, the reality is they're only typically selling a few of those options. And so for the insurance carrier, they have to price out each one of those benefit durations into their pricing. Whereas with SmartCare, we arrived at that 4 or 6 years, again, for the average length of long-term care claim, typically being less than 4 years to boost that monthly benefit. And then the 6-year benefit to provide for some of those prolonged claims, such as dementia or Alzheimer's. This allowed us to put our best foot forward in price and perspective for both those benefit durations that we think are most advantageous for clients. And then what I was talking about before, that secure achiever segment, right? So this isn't going to be the solution for everybody, solely for the aspect of a premium funding standpoint. Our maximum premium duration is 5 years. So it's really for those individuals that have the funds available for an upfront funded policy, single premium up to a maximum premium of 5 years. Now, we do see quite a bit of 1035 exchanges from existing life insurance coverage to SmartCare. Again, somebody purchased an old whole life, UL, VUL in the past, where their children were in the household. Death benefit was the primary insurance objective. Well, now the kids are out of the household. Insurance objectives really have shifted, with the primary need going from death benefit protection now to more of a long-term care need. It's a great solution to utilize SmartCare here. And again, whole life policy, a lot of those whole life policies, require premiums being paid all years. So again, this allows for a 1035 exchange to have a paid up long-term care policy with a death benefit backing. So if they never utilize the long-term care benefits, they're not left with nothing. One of the major takeaways when we look at SmartCare versus some of the other products in the marketplace is being a cash indemnity policy, right? So one, the ease of use. At time of claim, it's extremely easy. You don't have to worry about tracking receipts and submitting those receipts to the insurance carrier to later being reimbursed. Additionally, when we were looking at the cash indemnity aspect of the policy, there's a pure economic benefit of it, right? So when we look at policies, say you have a reimbursement policy and a cash indemnity policy, both those policies have the same exact pricing, for example sakes. So we're looking at a future benefit of, say, $10,000 per month as far as a long-term care monthly benefit. Well, if the client only incurred long-term care expenses, qualified long-term care expenses of $5,000 in that instance, the reimbursement policy is only going to provide them $5,000 to be reimbursed for those qualified long-term care expenses. Whereas the cash indemnity solution is going to provide them that full $10,000 monthly benefit and provide a lot more flexibility on how they use those funds. It provides for informal and family care, whereas the reimbursement plans typically do not. And then, when we look at our cash indemnity policy, it's also unique. One things that these slides don't talk about is international coverage. So not something that's going to be important to every individual out there, but I'm seeing it more and more frequently these days where individuals are looking to retire abroad, right? There's a lot of the ability to see your loved ones via your television screen, right? So people that traditionally may have not looked to retire abroad now may potentially look to retire in a vacation destination. Or there's the individuals that potentially just want to move back home towards family. A lot of individuals in the United States retire back in India or Israel. And so when we look at international coverage, Brighthouse has the most robust international coverage in the long-term care marketplace. Typically, everybody's going to either cut your monthly benefit in half or limit you to the first 2 years of long-term care claim. With SmartCare, we're going to provide you the full monthly benefit over the entire benefit duration. So extremely attractive long-term care solution if clients are looking to potentially retire abroad. James, we do not take partial 1035s. Elimination period, so pretty typical. We have a 90 calendar day elimination period for all services, kind of how some of the other options out there in the marketplace from an elimination period perspective. Again, to reiterate the options from a long-term care coverage option. So no inflation protection, that's our level option. Typically, we're one of the leaders in the long-term care marketplace when you look at no inflation protection for premiums paid. Then we have our unique index inflation option, allowing the ability to grow benefits based upon index account performance and 5% compound inflation. Here is how you look at the long-term care coverage options in comparison to some of the other players out there in the marketplace. And so when you're running 3% compound inflation traditionally at other carriers, that's typically when you'd see that indexed inflation option run with SmartCare. Now, from a return of premiums perspective, right? So we look at this and it's a pretty big conversation when we look at the return of premium aspect. Clients like the idea of fund these solutions, but there's always in the back of their head, what if I need the cash? What if my portfolio doesn't grow to what I initially anticipated? What if I'm a small business owner and something like COVID happens where my business was once thriving and now it's not performing that at the rate it was previously? And so having cash surrender value is an important conversation to have when we're looking at these long-term care planning solutions, especially if you're looking at a young enough client, right? Somebody in their 50s, early 50s, there's a long time horizon where a lot of things can happen. And so having an exit strategy with cash surrender value is a nice feature to have. If we look at some of the other carriers in the marketplace, one of the biggest providers, right, Lincoln, 70% return of premiums, never the ability to grow that. If we look at Securian, for example's sakes, they hung their hat on for so long having a 100% return of premium option. Their new reprice on their policy, they still do have that option at a significant reduction in their long-term care benefits. And then they have this long-term care boost option now, similar to that of Nationwide Care Matters, which a lot of individuals are running their maximum long-term care benefit. And so to give you an idea of this, right? So let's look at SmartCare's cash surrender value in comparison to the return of premium option with Nationwide. So for the best long-term care benefits that Nationwide is providing, they're utilizing this max long-term care benefit, right? And so with the max long-term care, it's a reduced cash surrender value. So as you can see, you're looking at it starting out about 40% of premiums paid from a cash surrender value perspective. And that has a potential to grow over time. Whereas you look at SmartCare, it starts out at 70% of return, 70% of premiums with the potential to grow that cash surrender value over time. And then this green line is the vested option for Nationwide. So they have the ability to vest up to 100% return of premium over 6 years. But again, that's going to be at a pretty significant reduction in their long-term care benefits. So when we look at projected cash surrender value of SmartCare, it leads the way significantly versus that max long-term care benefit. but as well as if we look at even the vested return of premium option with Nationwide, it exceeds that in the future. So extremely attractive option when you're looking at the three facets of the policy, right? Cash surrender value, long-term care benefits, and death benefit protection encompasses a lot with SmartCare, very competitive across the board for all three facets. Something that we are seeing more and more frequently, with the Biden administration and tax law changes that are coming into play, expected estate tax thresholds to be lowered, with SmartCare being a cash indemnity solution, we allow for the irrevocable life insurance trust to be an owner of the policy. So typically, the maximum face amount in the past wasn't so relevant to these conversations, but we're seeing it more and more. People looking for max funded long-term care solutions, putting the policy in their irrevocable life insurance trust. So as you could see, we do have the highest base amount available when we're looking at an individual basis, $1 million. Again, to reiterate the underwriting approach, up through age 65, just the digital application with our database checks, we'll have that underwriting decision within 24 hours. And then through age 66 through 75, same process of the digital application, but we'll have a cognitive phone interview with one of Brighthouse underwriters, and we'll automatically order their medical records on our end. Now, to give you an idea as far as a pricing perspective, how we look in the marketplace, I just want to give you an idea, right? So as we look at this, you'll notice we have our guaranteed values with SmartCare and our non-guaranteed values. So guaranteed values, as I was talking about before, we provide the highest guaranteed long-term care leverage in the market for premiums paid as of day one. So, $100,000 being paid into the policy. Our day one benefit in this instance, $6,900. The next highest carrier in this instance is SecureCare 3 at about $5,600 per month as far as a monthly benefit. And then we have the ability to exceed the marketplace with our growth. So, monthly benefit at age 80, about $12,800. Next highest carrier is about $12,000 per month. And then the ability for the highest death benefit with cash accumulation potential over time as well. So same story with females as well as males pricing. So again, we're looking at highest guaranteed day one benefits in the marketplace, ability to grow those long-term care benefits over time while still providing substantially higher death benefit than the marketplace, and the ability for the cash surrender value to be substantially greater than the marketplace as well. See here in this instance, our cash surrender value projected about $127,000. Next highest carrier is a $100,000 return of premium option at a pretty significant reduction in the long-term care benefits versus SmartCare. So those were 4-year benefits. As you could see, the story continues. It's going to be highest guaranteed benefits as of day one, the ability to grow the long-term care benefits greater than the market over time, better cash surrender value, and higher death benefit. And then another thing, like I was talking about before, that level option, right? So if you're ever running long-term care conversations without inflation protection, typically you're going to see that at those older ages, 65 into the 70s. Typically, you'll see it a little bit later than 65, right? Late 60s into the 70s. And so what you could see, extremely attractive guaranteed long-term care benefit as of day one. In this instance, that's 65. Just slightly less than SecureCare here, but providing about $20,000 more in death benefit coverage with the potential to grow the cash value greater. So for a pretty minimal difference in the monthly benefit, about $20,000 more in death benefit protection. And then as you can see, as we get into the older ages, it's the market leader in guaranteed long-term care leverage. And then for females, it's going to lead 65 plus without inflation protection. Even when you're looking at a 65-year-old females in their mid 60s and up, and you're looking at the inflation protection at other carriers, SmartCare typically provides the greatest long-term care benefit on a guaranteed basis, well into the 80s. So extremely attractive solution, whether you're looking at completely guaranteed long-term care benefits based upon our index growth, and again, the attractive death benefit and cash value projections. So that is all I have as far as the product and where it fits and everything. Again, I want to turn it over, see if there's any questions that I could help answer at this point.
Ken Smith does have a question. He
Yeah.
wants to know is the product guaranteed to the death of the insured?
Yep. So the initial guaranteed death benefit and guaranteed long-term care benefits are guaranteed for life. I'll pull that illustration back up for you real quick. Got it right here. So we'll just look at the guaranteed ledger again real quickly. Again, the growth with that index performance is not going to be guaranteed, similar to any index universal life policy you may be using for a cash accumulation perspective. But our death benefit and initial guaranteed long-term care benefits are guaranteed for life. So as you can see, we carry this all the way out. It goes all the way out on the illustration through 124, but it is guaranteed for life.
I don't see any more questions. And I think that I appreciate this, Matt. I think it was great presentation. What I really like about it is when you compare this versus a product with a 3 or 5% compounding on there, the pricing is so much better because you're not paying for that extra inflation protection, and your upside is still better. It's not guaranteed, but it is, I think a relatively safe assumption that we're going to get a moderate return in the marketplace to make those numbers be pretty realistic. And, if they do want that guarantee, then you can put the 5% on there that you offer. But overall, it just prices out very well against the competition.
Yeah, I mean, that's great perspective, Al. And to your point, right? It's not guaranteed, but over a long time horizon, the market typically does what it historically has done, right? And so that's one thing that some people just don't necessarily get in their head right off the bat, right? You're a 55-year-old, maybe you're a 60-year-old approaching retirement. So you're thinking more conservatively with your investment approach. And if we're looking at this for like a cash accumulation for income planning perspective, right? It's typically not something people would look at that age. But for a 55-year-old, you're looking at possibly 25, 30 years for a time horizon for a potential long-term care event. So definitely a different time horizon that we're looking at for a long-term care event versus a retirement perspective.
Yep. I think most agents are out there are now pretty comfortable with indexing and index products. So I think it just leads well with this, to kind of show that same philosophy with this product. I think it's very, obviously it's very unique, but pretty easy to understand when you have the point to point. And even people that are a little hesitant of indexing, I think it's a pretty easy concept to understand, and most agents are pretty comfortable with it. So
yep.
I don't see any other questions from my perspective. We represent, so the competition, the competitive analysis that Matt showed there with all those carriers, we have access to all of those. So if you've got a question, let's just say you're running, you've got a favorite company out there, give me a call. Let me run some comparison quotes for you. It never hurts to see that. If you wanted to see how it stacks up, let's just say you're working on a case right now and you're not sure which way to go, give me a call. We run the numbers. It's relatively quick and easy process for me to plug those numbers in and give you a snapshot of who the players are in the marketplace and what you're looking at, so you can help your client make an easy decision on which product to go with. I think that's it, man. I appreciate it.
Perfect. Yeah, I appreciate you having me on, Al. I appreciate everybody joining us today. If anything does come up that I can help with, don't hesitate to reach out to me or reach out to Al. And we look forward to partnering with you going forward. Thanks a lot, everybody.
Thanks, everybody.